if you want to get rid of the risk totally, see what happens here? If you manage to get this bracket equal to 0, then it doesn't matter how much you change in the interest rates. Because any change in interest rates times lots of assets times 0 will be 0. So you could get rid of your risk by simply changing the duration of the assets and the liabilities or your leverage such that this bracket here simply becomes 0. But there's some certain disadvantage of that one too. So the reason why we had that duration gap here is, of course, we do maturity transformation. Long-term mortgages, short-term deposits. And you remember, we're riding the yield curve. On the yield curve, short-term interest rates, very small. Long-term interest rates, much bigger. So therefore, if you do maturity transformation, getting money short-term, cheap, and lending it out long-term, expensive, we make a profit. As a side effect of that profit, we've got the duration gap and therefore interest rate risk. If you want to get rid of the interest rate risk by having less maturity transformation, we will also get less profits, of course. Because if you're trying to get all the customers into 5-year savings accounts, you have to pay them much higher interest rates. So your profits are going to go down. Gray means not important, so duration is just an approximation. If you're interested in this in advanced finance class, we will do something about convexity. Not in our class, that's the reason why it's gray. It's just that you saw it once, so duration is only an approximation. So this part I can still do. What is the cost of such a strategy? So if you're trying to link the durations of the assets and liability side, so if you, for example, increase the duration of the liabilities, it's going to cost you. And that means we have less profits. That's number one thing. But think of for society. Are you happy if the only possible investment for your money is a 5-year savings account? Or are you more happy right now that you can have some money in a deposit account, some on a savings account? I reckon it's a better choice now so that you can choose where you have your money. And there's lots of short-term investment opportunities available for us as customers in the bank. So I like that personally, that I can have very liquid deposits in the bank. And of course, if the banks want to get long durations on the liabilities, that means they couldn't offer us these short-term deposits anymore. So that's a disadvantage of straight duration matching here. And that's the reason why banks came up with another idea too. Derivatives. So we've already learned about foreign exchange derivatives, forwards and futures beforehand. We've learned about stock options beforehand. And we tiny bit touched on swaps as well. Now, lots of these derivatives nowadays are actually used by banks to hedge their risk. And one of the risks that they're matching, one of the major ones, is interest rate risk that we just had beforehand. But we can't see that on the balance sheet because they're not fiddling around with the assets or the liabilities, but they're writing additional contracts off balance sheet. We want to do that now too. So how does that work? It's called macro hedging with bond futures. Macro hedging means that we don't hedge a single mortgage or a single bond position, but we're hedging the whole balance sheet in one go. So our problem beforehand was we had a certain duration gap, which was causing interest rate risk for our bank. And we can use futures to get rid of that interest rate risk. Now, how does that work? Step by step. First, we have to remember what a future is. In this example here, we've got a bond future. So we have the right to buy or sell a bond. In this example here, it's short. It means we have the right to sell a bond. Now let's think of what happens with that right to sell a bond. First, I want to link the value and the duration of the future with the value and the duration of the bond. So this is a short future. Let's say we have here the exercise price, $80 for a $100 face value bond. Remember, short means that we have the right and the obligation at the same time to sell bonds, short. So we are on the selling bond side now. So we have a contract where we have promised to sell bonds at $80. if in the market the bonds are worth $90, are we happy or unhappy? Unhappy, right? Because we could have sold our bonds in the market at $90, but unfortunately we have a contract that says we have to sell them at $80, let's say in 1 year's time. So we are now unhappy if bond prices go up. Now let's link that one to yields. Bond prices go up if yields went down. So we are unhappy if interest rates go down. And in the other direction, if interest rates go up, we will be happy. Let's do that step by step too. If interest rates go up, the value of the bonds in the market go down, but we do have a contract that says we can sell our bonds at $80. If the market price is only $70, we're going to be very happy that we can sell our bond at $80. And not only will we be happy, that piece of paper that says we can sell bonds at $80, will you be valuable or not valuable? Valuable. So a short future, a short bond future, is gaining in value if interest rates go up. That's actually quite important. Step 1. Step 2, by how much is it gaining in value? Let's say bond prices fall from $80 to $70. How much value will this piece of paper gain? Let's say if the price of the bonds falls from 80 to 70, a piece of paper that allows you to sell a bond for $80 is worth $10. So basically the value of the future contract is changing 1 for 1 with the value of the bond itself. The bond changed by $10, the future contract changed by $10, just with an opposite sign. Bond price down by $10, future up by $10. Let's go the other direction. If bond prices go up to $90, the value of that future now goes, you can see that in the graph, down by 10 also. Now we can do one step further, linking the interest rate, change in interest rate, to the change in bonds. So if I've got a 30-year bond and I change interest rates, then the formula to calculate the change in the bond price would be the change in interest rates divided by 1 plus r times the duration of the bond is giving us the percentage change of the bond price. So instead of F, just imagine bond here. And then it's exactly the same formula as in week 1. So the relative change in the bond price we can calculate from the relative change of the interest rates times the duration of the bond. And now since the future is moving 1 for 1 with a bond, it means that we can use the same formula for the future as well. Because the future is moving 1 for 1 with the bond, just in the opposite direction, we can use exactly the same formula. So we can have a formula now with the duration, where the duration of the future, which is the same as the duration of the underlying bond, times possible interest rate changes, is giving us a change in the value of the future. So we can again use the duration here to calculate the change in the value of the future. And now remember, a short future is gaining in value if interest rates are rising. Let's link that up with the problem from beforehand. The bank was afraid that interest rates go up or down? Up. That's what the bank is afraid of. If interest rates go up, we've learned here beforehand in our example here, the bank is making a loss. So this bank is afraid of interest rates going up. Imagine if this bank is signing a contract, a future short contract, is shortening bonds via futures. Now if interest rates go up, it's bad on the balance sheet. But the value of the futures goes up too. And if you buy exactly the correct amount of futures, these two might balance out. And then we got rid of our risks. So the future, the short future, is insurance for the bank against interest rate risk. Now the last step, we have to figure out how many of these futures we need. So that's basically this idea here. Because we know the short future is going the opposite direction of our change in equity, we can just align these two, that these two effects exactly balance out. That will be beautiful, then we don't have any more risk. These two equations are basically the same. I just have times f. So I know del f is this one. Del f, let's copy that down, df times f one plus r. So we've got this one here. And then we've got also this formula here. So I just copied down the two formulas from beforehand. The minus sign here, it's a long future position. So if you have a short future, you would skip the minus sign. Right? So the idea is now the following. If I have this one on balance sheet, and I buy additional future off balance sheet, then the total change for the bank, which I just call now delta B to keep life simple, is the sum of these two. So I can have this one, df times f 1 plus r, and then I write this one on top too, or yes, plus, and then minus dA dl times k times a times interest rate 1 plus r. Right? So this is what's happening off balance sheet because I wrote the new future, a short future. This is what's happening on balance sheet because I have a duration mismatch between my assets and my liabilities because I give long mortgages, short deposits. And this is the total change then from the bank out of these two different, if I add these two up. Right? Because I have the contract that is changing in value and I've got my balance sheet itself. And of course, if you want to get full insurance, if you want to hedge all the interest rate risk away, how much change do we want to have for the bank? If you don't want to have any risk, the change should be exactly 0. So we just set this one 0, equal to 0. And then we can reshuffle a lot of things. So once that side is 0, these things are disappearing. What else do we have here? We keep the f, the a, f, df, and all these other ones we keep here. And we can reshuffle it. F, in our example here, is so how many futures we've got, not only one, but several, is the number of future contracts and the price of each future contract. Because future contracts are usually not done for like one $80 bond, but usually in terms of hundreds of thousands of dollars worth of bond. So instead of F, then write into the formula NF times PF. So the number of future contracts times basically the size of each future contract. Right? Because we're not just buying one $80 one, but several hundred of $100,000 of worth of contracts. So I can put that in there. dF times NF times PF minus dL times K times A. And what they've done now basically is we want to have NF on one side. We want to know how many future contracts we have to buy. So they bring this one over to the other side and then divide it by DF and PF. You can see it. So I bring this to the other side. Then I have dA minus dL times K times A equals these dF NF PF, and then I just divide by dF and PF, and I get on this side is left over the number of future contracts I need is the adjusted duration gap times how big my bank is divided by the duration of the future contract that I can buy divided by the price of the future contract. So why did I do that? Number one, of course, you don't need to, for this class, you don't need to prove any kind of formulas. You just use the formulas. But why did I do that for you now? If you buy this many contracts, future contracts, what have you achieved? Zero change. So it doesn't matter now. If interest rates go up, well, our balance sheet doesn't look that good. But therefore, our futures, we're making a lot of profit on our futures. So in the end, it doesn't matter for the bank. If interest rates go down, our balance sheet looks very good. But the future contracts, we make huge losses. So in the end, it doesn't matter for the bank. So we have fully hedged in this example. And the beauty of this fully hedged is, did we have to change our deposits? No, we didn't do anything with our deposits. Did we have to offer our clients more interest rates? No, nothing. We didn't have to change the mortgages, nothing. We can do whatever we want on our balance sheet, but we still got rid of all the risk by using futures. And that is, of course, the reason why most of the future and forward contracts are actually used by banks and not by us. The main reason why we've got so much derivatives and why a few weeks back we've learned that the derivative markets are so huge and active is because the banks are fiddling every single day on these future markets to ensure the interest rate risk. They're adjusting to it every single day, always looking for the cheapest insurance. So that's the beauty of these insurance. Next beauty is the following. Let's imagine you went short on all these futures. And let's assume interest rates simply go sideways. There's no change. Number one, what happened to your balance sheet if interest rates didn't change? Any gains or losses on the balance sheet? No, it stays the same as yesterday. Number two, if you don't change interest rates, does the value of your future change? Stays the same too. And here's the beauty. How much money did you have to pay when you signed up for the future? In the moment when you're signing up, you sign a contract that you will sell bonds next year. Did you have to pay any money? No. When you're signing a future contract, there's no money changing hands at all. Maybe a tiny, tiny, tiny fee, but it's basically nothing in the terms of millions that we have here. So a future contract almost comes for free for the banks. So you can insure your complete balance sheet pretty much for free. That's the reason why they're so popular. And that is much better than trying to get millions of your customers onto a high-paying, interest-paying savings account. That would cost a fortune. So it's a much easier way for banks to get rid of their interest rate risk. One more step, interest rate swaps. So what's the idea here? An interest rate swap, I think, is best understood by looking at this type of graph here. So you've got simply two different entities. One, let's say one is a bank, one is a dealer, and they're literally swapping cash flows. The bank is approaching the dealer and says, listen, if I want to get a floating interest rate from you, so I want to get cash flows that are adjusting with floating interest rates. So if interest rates go up, I want to have more cash flows from you. If interest rates go down, you pay me less. How much do I have to pay you fixed in return? And in this example here, the dealer simply says, well, I want to earn at least 7% fixed. So the thing that they're swapping here is only the cash flow. It's not that the bank is giving over all the mortgages, for example. They're just giving the cash flow from the mortgages to the dealer. 7% fixed. Now what's the beauty of that one? On the bank balance sheet, we do have now still the mortgages with the fixed interest rates. And usually you would think that means because the duration is long of these mortgages, if interest rates go up, the bank is worried because they've got all these fixed payments and their cost is variable. But if they've got a swap contract, they can't adjust the interest rate on the mortgages. But if interest rates go up, what's the advantage for the bank once they've got these contracts? Are they still all unhappy about interest rates going up? Now, there's one advantage if interest rates go up. they will get more interest from the dealer because they made that contract. You pay me variable interest rates, and therefore I pay you fixed. So I changed my fixed payments against variable payments. So later on for my profits, the fixed payments that I get from the mortgages, they're going to somebody else anyway. I don't care about them anymore. I care about the variable payments that I get in. Let's say a bank had in the past raised $100 million by issuing 4-year notes with 10% fixed coupons. So first question for you very quickly. Bank A, the $100 million 4-year notes, is that on the asset side or the liability side? So we've got bank A, bank B. So initially raised $100 million by issuing 4-year notes. Where should I write that down? On the liability side or the asset side? Since they raised the money and issued bonds, is that funding or investment? Funding. So banks can also issue bonds. They don't only have to buy bonds, they can issue bonds, and that's what happened here. $100 million. So 100, 4 years, 10%. And how did they invest it? On the asset side, variable rate loans, earning cash rate +1, duration 0. So on the asset side, they give variable rate loans, meaning that the interest rate on these loans can adjust any time. And because it can adjust any time, we call that duration 0. Now, what's the logic here? Remember, duration is not only the average time till you get your money back, but it's also how sensitive is the value of that asset reacting if you change interest rates. But if the interest rates are variable anyway, doesn't matter if interest rates go up or down, you invested in a variable rate bond, and now interest rates go up. Usually if interest rates go up, bond prices go down. But if the bond has a variable coupon, which is adjusting to the interest rate that is right now on the market. So yesterday the bond was 10%, now interest rates go up. Now the interest rate has a 15% coupon because it's a variable interest rate bond. Is that becoming less attractive compared to other bonds with 15% in the market, or the same? The same, and therefore it's still traded at 100% face value. So variable assets, their prices don't go up and down with the interest rates. The present value doesn't change because the future cash flows simply adjust to it. That's the reason why the duration of those is 0. Duration is 0. Let's make it with commas. And the interest rate is the so-called cash rate plus 1%, because the bank wants to earn a little bit extra. So whenever the cash rate goes up, the interest rate on this loan is going up too. Whenever the cash rate goes down, the interest rate goes down too. Good, so that's one bank. The other bank B, 100 million fixed mortgage rates, 5 years duration. So they've got now here 100 million, duration is 5 years. Does it say the interest rate too? 12%. So this is dollar, duration, return. And now here they've got funded with certified deposits. CDs, don't get stressed by it. It's just some kind of special savings account you might think of. And that is cash rate plus 1. So 100, duration of 1 year. So they're running for 1 year. Is the interest rate fixed? But then they are adjusting to cash rate plus 1. Plus 1%. So let's check what kind of risk they are afraid of. So both of them have interest rate risk on their balance sheet because the durations don't match up. 5 year, 1 year. 0, 4 years. So we have a duration gap for both of them. This is your typical bank, bank B. Long, short. So here now, if interest rates go up, bank B, happy or unhappy? Can they change these interest rates over the next 5 years? No, they're fixed. What happens after 1 year on these interest rates? If interest rates go up, cash rate goes up, these go up too, and the profits of the bank will go down. So this bank is afraid of rising interest rates. They've got interest rate risk on the balance sheet. Now this bank, short, long, a very unusual bank, right? Banks usually don't look like this. Private corporations maybe. So you can take a guess. If interest rates go up, sorry, I should have written it on this side. Interest rates go up, Bank A, more or less profits. Happy or unhappy? Very happy, right? They increase the interest rates here that they earn on their assets, and these are fixed for 4 years. So they're going to be happy. And you can see here, they've got opposite risks, because we don't know if interest rates go up or down. Maybe they go down. Then we have this picture, of course. So there's risk for both banks. But the beauty is the risk is going in the opposite direction. Just as we had in the example with the futures and the derivatives, the risk of wheat prices going up and down for the bakery and the farmer. They are on opposite sides of the risks. And we could make a future contract, but there's something else that they can do here now. They can swap. They can swap payments. And the payment swap that we're doing now, the interest rate swap, is the following. So here, that's the same thing as happy or unhappy, right? We looked at the duration gaps. They go in opposite directions. And B is swapping the fixed 11 with A against variable cash rate. Okay, let's see. So B is pushing over 11% fixed interest rate here. And A, therefore, in return, is paying B, I think the cash rate plus 1, it says. So these are the payments that they're swapping. B is paying fixed, A is paying variable. That's the swap contract that they have. Remember, the mortgage still stay here. These liabilities still stay on the account. So we don't change our assets and liabilities. We just push over some of the cash flows. We are swapping cash flows with somebody else. But now let's see what's happening. Beforehand, Bank A was unhappy if interest rates are falling. That was bad for Bank A. Let's see what's happening now. So if interest rates are falling, let's see what happens here. They're earning less on their assets, you might think. But also, what's happening to the payments to Bank B? They're falling too. See how these two balance out? Basically, what's happening here is these cash flows, the bank is simply pushing through what they're earning here. They're earning less on their assets, but that doesn't matter for them because all these earnings are going to Bank B anyway. But they do get paid fixed, 11% here. So they get paid 11%. So now we can see these earnings just go away to the other bank, but they earn 11%. They pay to their customers 10%. So what's going to be their profits? 1%. And doesn't matter if interest rates go up and down? No, because the variable interest rates go away to the other ones anyway. We get fixed 11%. We pay fixed 10%. So we always make 1% profit. Bank A has now 0 risk. They always get 1% profit. Doesn't matter if interest rates go up or down. So we got rid of the uncertainty with the swap. So it's good for Bank A. Let's check what's happening for Bank B. Bank B, beforehand, was afraid of interest rates going up because it was costing them more with their customers. But let's see, and they had fixed returns here. Let's see what's happening now for Bank B. If interest rates are going up, they have to pay their customers more. That's bad. But also, they get higher payments from Bank A. And that's exactly canceling out. It's basically as if Bank A is paying Bank B's customers interest rates. So we don't have to worry about this anymore. This is just channeled through. We take the money from these customers, give it to the customers of bank B. So basically the inflow here to the outflow here, balances out. Receive cash rate, pay cash rate, same interest rate, balances out. But let's say here, we collect from our mortgage customers 12% fixed, and we pay the other bank 11% fixed. What's happening to profits? 1%. Doesn't matter if interest rates go up and down? No. So both banks got rid of their interest rate risk. So in that sense, both banks are happier, and not only did they get rid of the interest rate risk, they have a sure profit, both of them now. They don't have to worry, and they're both remaining profitable. So that is what swaps are for, and that's the reason why banks use a lot of swaps to swap these kinds of cash flows. And I know if you see it for the first time, it's confusing. So 2 hints. Number 1, imagine swap literally as swapping cash flows with somebody else. You get my wage, I get your wage. For example, that would be a swap. And second hint there is maybe reading on this one. So Lange, Saunders, Cornett. The textbook is more advanced than what we do in this class, but the explanation for the swap contract and for hedging risk via the swap contracts is exceptionally good in this book. That's the reason why I use that book for these chapters. If there's something way more complicated than what we do in class, just skip over these parts. But the interest rate part is actually quite well written. I recommend reading that one. Future swaps, also very cheap. There's hardly any fees involved, so they're very, very popular.